All right. Thank you for making it. I think we're streaming YouTube, Facebook, LinkedIn. We got an excellent media guy. So let me know if you need somebody to do some of this work for you. I'll give you his name. But hey, Jesse, thanks for being here today. Thanks for collaborating with me and helping me get the word out on 280E and where we are at now in terms of what are some of the steps that the cannabis industry can take, what are some of the actual facts that are out there versus all the media and what you're hearing in news articles and what's, as far as like, I wouldn't say it's necessarily misinformation, but it's definitely not the entire story. And I'm actually never endingly surprised about the amount of information that people don't have. I take it for granted because we do this every day, day in and day out, but I'm not hearing what I know, which I think people should know about this topic. And I think it's important, especially right now, to get this information out. So, hey, Jesse, before I begin, do you want to introduce yourself? And
yeah, I mean, Jesse Bonacue, the executive director of the CIAO. I'm actually really excited to hear what you have to say, Justin. I'm always trying to learn more. And, it is a little bit chaotic time. There's lots of rumors and speculation and things that fly back and forth. And just trying to help understand, and I'm excited to learn more about what's real and what isn't, and how to be thinking about the upcoming potential changes and or what's happening with some aggressive and legal maneuvering by some large cannabis players and what the story is behind all that.
Mm-hmm. Yeah, we'll definitely go over that. And then for people who are watching, you can you could in the comments put questions, and then depending on if it's relevant to where we are in the presentation, it might go up and I'll stop and answer that. But for now, I'll just go ahead and dive into it. We've got about an hour, so I'm going to try to be as quick as possible. I won't go into detail on everything because there's a lot, but I am going to highlight a few points that are like kind of the predominant arguments about, and really just to skip to the chase, this is about, even though 280E is still in the code, the tax code, what can the cannabis industry do about it in advance of the rescheduling of cannabis? So you may know, so this is definitely a 401 level college course. So I'm not going to go into a lot of detail in regard to what is 280E and how it applies. I mean, it should be known that 280E disallows overhead expenses and you get taxed on essentially your gross profit, right? So that's what on your tax return, you get taxed on that top line gross profit, not your bottom line net income, because 280E disallows your overhead expenses. And a lot of you are aware that there's some games that we've been playing over the years. And there's probably some tax acrobatics your accountant is doing in terms of bifurcating your square footage, bifurcating payroll to deductible versus non-deductible, those kinds of things. If your accountant's not doing that, at the very least, then you have been getting doubly screwed because that's something we've been doing for nearly 10 years. But I'm going to talk to you about where we are at now. But in order to talk to you about where we are at now, we need to talk about where we were, because the reason why I want to touch on this is because as we move forward with some of these, what we can consider aggressive approaches that are being taken on by the cannabis industry, we need to understand how the IRS has responded in the past for equally aggressive moves, but that were in the past. Now we're on we're playing a different game. So with that said, I've got this slide deck. It's very long. It's very detailed. It outlines all arguments that we have for moving forward without reducing deductions for 280E, as well as amending prior year tax returns, and all the arguments that we're using in order to justify that. And if you want this, reach out. It's actually just a slightly older version is on my website right now, but if you want this one, I'm going to get that posted so that you can click on a link and then you can download it. But if you want it like right away, feel free to email us and I will email you this current slide deck that has the links. It has links and everything too. So I'm not going to go over what the Controlled Substances Act, you know what it's about. The Controlled Substances Act will play a part in our conversation going forward. So I guess I'll tell you a little bit about it, but that's what it's the federal, it's the language, I guess, the federal language that guides the federal government on regulating drug policy federally. By extension, that's what if you're operating in a Schedule 1 or Schedule 2 drug, according to the CSA, according to the Controlled Substances Act, then you are also subject to 280E. As you know, when I first got my start, I was doing some cultivation tax returns prior to 2014. About 2014, that's when dispensaries started to roll out. Medical dispensaries here in Oregon, and most of the people here today are from Oregon because we're with Jesse here, and that's when I started doing those tax returns and I started to like realize what the ramifications. That's when I started really realizing what the ramifications of 280E was, and we're talking about at that time 80 to 90% effective tax rate. So that means like for every $100 that a dispensary makes, those people were geared up to pay 80 to 90% on it. So that's a huge and bonkers number. And so at that time, I was like, there's no way. There's no way that these people can, we could do these tax returns and these guys stay in business. We're going to mire them in tax debt right away. Like, and how is that even possible? So I went to, I did some continuing education in Colorado. I met with some very smart people there. One of the methodologies that the cannabis industry at that time was using was a code section called 263A. And 263A is like almost like a penalty on manufacturing companies, forcing manufacturing companies to allocate some of their overhead into inventory and thus being able to deduct some of their and then deducting their inventory while matching it with income. So the whole idea of inventory, cost of goods sold, and income is to match your cost with your income. That's why it says cost of goods sold. And in order to do that, you have to keep track of inventory. So this code section that not a lot of people understood or even used was picked up by the cannabis industry, and then we were able to start to use it, kind of reversing the intention of Congress and the IRS here. Because now what we're saying is, well, instead of disallowing all of our deductions, we're going to take part of our deductions, our manufacturing related deductions, we're going to put them in inventory and then deduct them as cost of goods sold as to offset our income, and thus move overhead into cost of goods sold, which is allowed under 280E. Unfortunately, and this is really important to know, to pay attention to this, in the tax code, that's not allowed. It says in the tax code under 263A that if an expense is otherwise disallowed due to another tax code, i.e. 280E, then you can't use 263A. You can't deduct the expense under 263A. So that's a big important thing to remember about this tax code. And I will let you know it's going to apply again later on in this presentation. But essentially, that's how, what the cannabis industry was doing at the time. And then that is what ultimately, the IRS pointed that out and said, like, no, you don't get to take those deductions under that code section. So at the time when at this continuing education in Colorado, I was introduced to 471. 471 is another manufacturing related inventory tracking code in which you can take your overhead expenses, a part of your overhead expenses that are related to manufacturing, include them into inventory, and thus, and then we could deduct them as cost of goods sold. Into inventory. There's a little bit of some feedback there, and that is allowed. Unlike 263, 471A allowed us to do that. So most of the cannabis accountants that were, staying informed switched over to, definitely started doing this overhead allocation where we would do like a map of the dispensary. We would say, okay, this part where we're bagging and tagging product and weighing is all manufacturing related, and we're gonna deduct that. And then the payroll for the people who are in the back doing working on those types of activities is deductible. And then if they're in the front selling, then it's non-deductible. So it was a lot of painful tax acrobatics that we were doing at that time. And to be frank, we were we were taking a lot of risk anyway, because this really does apply to manufacturing, not retail. So all those people who are using 471A for their dispensaries, unless you were vertically integrated, but even then, to say that your retail part of it was, we could use 471 for the retail part of it, that was a big risk. But you know what? The IRS, and this is important, the IRS said okay to that. They're like, that's reasonable. You're meeting us in the middle. We'll let you have it. And that's how when people were getting audited, ultimately the IRS would be like, well, is your cost of goods sold a reasonable amount for what you're trying to deduct here? And then my clients, I've only had 2 cannabis audits, and one of them was this 471A, and ultimately they're like, we don't like how much you tried to write off in cost of goods sold, so we're gonna take away some of those deductions to be a little bit more reasonable. And so ultimately, that's what they landed on. That's not code, So anyway, it was kind of interesting. But then we got a huge relief with 471C. So in 2018, the Tax Cuts and Jobs Act was passed and 471C was passed, and it hugely simplified the inventory methodology that we were allowed to apply to these cannabis businesses now. Because ultimately what it did is it superseded 471A. It got rid of 471A. Okay, 471A is no more. 471C superseded 471A. And the code is very simple. It says you can include in inventory what you want, as long as it's based on your books and records. So it doesn't say that specifically, but that's the gist of it. You can move overhead into inventory, or you can create your own create your own inventory methodology as long as it's based on the books and records of your organization. So meaning that, again, let me just repeat that. You can move overhead into inventory and report it as cost of goods sold as long as it matches your books and records. That is what the code says, period. So in 2018, 2019, 2020, it was a free-for-all. The accountants were like, 280E is dead. We're using 471C all the way. We're going to save our clients millions of dollars going forward because this is the workaround to 280E. Well, ultimately, the Treasury Inspector General for Tax Administration, TIGTA is what we call it. It is the governing body of the IRS, and it got wind of the loophole that the cannabis industry was using to get around 280E, and it put pressure on the IRS to do something about it, to close the loophole. So then we ended up getting some regulation. So the IRS, like a wet blanket, put on top of 471C some regulation. And this is where the conversation about 263A is important, because unlike the tax code that we all have to abide by, regulation is just an interpretation of the code. Or if there's ambiguity around the code, then the IRS would create regulation to advise us on how to interpret the code. Well, this regulation was not an interpretation of the code. It was not clarifying the code in any way. What it was a deterrent to try to get the cannabis industry, the accountants, to be afraid of using 471C. Even though the IRS doesn't write the code, the IRS doesn't write the code, it interprets the code and it enforces the code, but it doesn't write the code. And so this regulation, essentially what happened was the IRS tried to put over 471C that 471C doesn't apply to expenses that are otherwise disallowed by another code section, similar to the 263A language. But the difference between 263A and 471 is that the language that the IRS used was in the code, but it's nowhere in 471C. Big overstep by the IRS here, big overstep. And so my colleagues and my business partners and I moved forward with 471C in, even after the regulation, again, saving our clients millions of dollars, where we were getting, but we also got tons of kickback from other professionals in the industry saying, hey, you're putting your clients at risk, you're going to get them audited, yada, yada, yada. A lot of fear mongering, similar to what's happening right now around amending and moving forward without 280E. That type of sentiment was happening then when this regulation came out and we continue to use 471C. They were saying, no, you shouldn't do it because you're gonna get audited. And there were audits, not my clients necessarily, but there were audits. The thing about those audits though, is they didn't dispute 471C. They did not dispute 471C. What they did was, if the books didn't match the inventory methodology, which was part of the tax code, if you were going to take an aggressive inventory methodology, then you need to make sure your books back that up. But if your books didn't back that up, they can have their way with you, and they did. And so there were people who used 471C that the IRS did make adjustments, but because they didn't follow the tax law, not because the IRS agreed or disagreed with the tax code. Again, the IRS is just trying to do their job, and their job is to enforce the tax code. The TICTA pressured them to do something about 471C to deter the use of 471C, and they put that regulation on there like a wet blanket, and it worked. But then there was a big part of us that just said, nope, we're ignoring that regulation. Well, we don't ignore it. We tell the IRS in the tax returns, we don't agree with this, and this is why. File the tax returns, move forward using 471C. And again, I just want to reiterate that as much as there was a bunch of fear mongering around it, threats, all sorts of stuff, the IRS didn't blanket audit everybody, didn't even dispute 471C, never went to tax court, never got disputed, and is still into use right now. So that's the point that I wanted to really hit home in terms of going back and letting people know where we were and how the IRS responded to the facts, to the actual tax code and what we're doing here. Let's see, do we have any questions so far? All All right, I'm going to go ahead and move on. And there may be questions, but if they're not like pertinent to this presentation, then they're not coming up. That's what I wanted to be clear about that. So a little bit more about 471. See, you can. Okay, perfect. Can you give an example of what an adjustment means? Adjustment means that they disallowed deductions that you attempted to take. They said no. They said no to your deductions. So say like in the audit that I was involved in, it was 471A. We did square footage, we did payroll allocations, and then we put a bunch of costs into cost of goods sold. It went to the audit. It went to appeals. The settlement officer was like, well, we just think that your percentage was too high, so we're going to disallow 10% more of what you claimed, which was it went bad from worse. But ultimately, they used a professional. They they had a reasonable basis for using your arguments. And that's something that people need to know about, is like all of the biggest, highest profile audits that these companies lost over the years that you may have heard about on the news, or if you look online for historical tax court cases, those people like Harborside and these other businesses that lost these tax court cases, ultimately what happened was they lost their deductions. They were penalized, but the tax court abated those penalties. Meaning, worst case scenario, you lose the deductions that you tried to claim. You don't get hampered with penalties. And that's something that I saw in one of these articles, is that they were saying, hey, you're going to get, audits are the worst. You're going to get penalized, and they're going to put all these penalties on you. That's not necessarily the case. They will, if you prepare a properly filed tax return with a reasonable basis for your approach, and you use a professional ideally, then they will abate those penalties, because we have a very strong and reasonable argument to take the position that we are taking. So the worst case scenario is a long audit process, which is annoying. And so they may find other things. If you don't have good books and records, they may find other things, and they may be like, they're going to beat the shit out of you because of how you did your bookkeeping. But if you've got strong books and records, and you've got substantiation to back up your expenses, then the worst case is they don't give you the deductions that you wanted. That's the worst case. I mean, the worst case, if you don't have books and records, is they'll get you on your lack of books and records. And that's how they did most of these companies. Can we amend our taxes, or is that a red flag for the IRS? I'm going to get to the statute of limitations section a little bit later. I want to talk to you about the current approach, the main methodologies for potentially amending your tax returns for moving forward without 280E. So really quick, Congress, it seems to me that Congress's intent is to give the states the rights to regulate their own cannabis regulation, right? Or to enforce their own cannabis regulation. You got the Cole memo, you got the Rohrabacher-Farr amendment, you got the announcements from the Health and Human Services, the DOJ, the Joyce-Blumenauer amendment. These are all things that have taken place as federal agencies or in Congress that kind of lean towards, well, Congress actually is thinking that it's an okay thing for states to have their own cannabis policies, and maybe we should leave them alone, right? Well, 280E doesn't say that. 280E is just like, I don't know, it's just like a little thorn in everybody's side that's making us miserable, but it's at the same time, it's as flimsy as a dried leaf in fall. You know, it's just on the tree, but barely hanging on there, and it's still around, even though from my perspective, Congress wants to let it go, but it's not going. The big thing is the Farm Bill, though. I mean, talk about like Congress not caring whether or not cannabis should be legal or not. The Farm Bill, of course, as you know, legalized hemp, but when it also legalized hemp, it also created a loophole for THCA because it did not exempt THCA, but in the language it didn't include, or it didn't accept THC, but in the language it did exempt THCA. And everybody knows that THCA is the precursor to THC. You light it up. That's why when you eat weed, you don't get high because it's THCA. But then you eat weed or you smoke it and then it becomes THC and now you get high. So pretty much they legalized marijuana. and then the people who kind of wised up to the fact that marijuana is being sold in gas stations and convenience stores and online right now, there's a huge market right now of you can buy weed right now online. They're saying intoxicating hemp. It's hemp. It's legal according to the Farm Bill because they got rid of THC, but they didn't say THCA. Okay, so all the cannabinoids but for THC are legal and THC is not legal. So, and the reason why I say Congress doesn't care is because we have a majority Republican Congress right now, and they're fighting, the Republicans are fighting against closing loophole. So what are they saying there? They're saying like, hey, intoxicating hemp okay, state regulated marijuana not okay? That's stupid, you know? So there is the Miller Amendment. The Miller Amendment has been being pushed by Democrats to close the loophole. The Republicans are pushing back though. They're saying don't close the loophole because they don't want to hurt the farmers. They don't want to hurt the hemp farmers. They are saying packaging, they want child-proof packaging. They want testing. If you want to get the medicine out to as many people as possible, this is the way to do it, the Farm Bill. But we definitely need testing. We need child-proof packaging. That doesn't seem to be happening right now. So marijuana is being sold untested, unpackaged in gas stations all across the United States. Horrible. And it's really hard on the states with the rec programs, especially those that have to comply to 280E. Okay, I will leave that alone. That is a different soapbox. Okay, so when this happened, when Trulieve amended their tax returns and got $113 million in refunds from the IRS for amending their tax returns, my ears perked up. I was like, what happened there? And we should all be paying attention. And why can't we be doing that too? And so far, I haven't heard of them being audited yet, So that's like, so what are we doing sitting back, like being afraid to follow suit just because we don't have as much money and we can't hire the most expensive lawyers there are? Now, when this happened, I went and started try to get some information. Why did Trulieve get their $113 million? Like, what was the argument? Like, how did they justify doing that? Well, they didn't tell anybody. They kept it very secretive because they didn't want to play their cards. They didn't want to show their cards. And so when they get audited, or if they get audited, then they're going to be able to like argue, and they're not giving the IRS or they're not at least giving the public the whole argument, right? So, but since then, we've had at least 4 or 5 more other large MSOs announce that they're no longer going to reduce deductions for 280E. They're going to amend their returns. The question that I have is why? Why is that? Well, the word got out. Fortunately, some of these people talked, and let us know what their argument was. And then there was also this court case Canada Provisions and Verano Holdings leading the charge, suing the federal government, saying, hey, 280E shouldn't apply. And the reason why is because it's unconstitutional due to the Commerce Clause. And many of you may have heard this already, but I will explain it for those of you who haven't. In 2005, there was a court case called Gonzalez versus Reich, went to the Supreme Court. It was a California operator suing the federal government saying, hey, what we're doing is intrastate commerce. We're not allowed to go across state lines. We can't ship across state lines. And the federal government's authority is only for federal-wide issues and not individual state-wide issues. They do not have the right to govern states that do not, state policy that doesn't affect the entire country. And so what they're saying is that, yes, when substances cross state line, that's a federal issue. But if substances are not crossing state lines, if we're not allowed to export, then it's not a federal issue. And by forcing the CSA on us in states that have their own cannabis regulation, by forcing the CSA on us, by subjugating us to 280E, that is a violation of the Constitution, of the interstate commerce or the Commerce Clause. That's the argument. Now, in 2005, we had a much more liberal or federalist Supreme Court. And they were like, well, and there was only like 4 states, right? 4 states that had even medical programs at that time. And I think Colorado was, or Washington was the first. I can't remember. It's been to have a rec program. So it's been a long time. So I don't remember who was first, but there was very few states that had a regulated program. So the federal government, the Supreme Court was like, no, your cannabis policies have an effect on the whole United States. So therefore overruled. The CSA still applies nationally. At that time, there was 2 Supreme Court justices, Justice O'Connor and Clarence Thomas, that dissented, saying that essentially we think it's unconstitutional. Later on, Justice Thomas' response to the Standing Akimbo case, he also went back and said he thinks that if this same court case went back to the Supreme Court, it would be overruled. The outcome would be different. Okay, so that's kind of what these guys are banking on. Verano Holdings and Canada Provisions and the people who are also suing the federal government. And it went to the first district court, but then it got rejected by the court because there was already a Supreme Court precedent. So the lower courts can't just say, oh yeah, we think you have a good argument. No, they have to side with whatever Supreme Court precedence there is. So it got rejected. So in the media, when I saw the articles, it was like, turned down, like, no, the judge was like, no, you can't do this. But it's really because there's Supreme Court precedent, and that when they went into the first court, they knew that it was going to get dismissed. And the judge ended saying, hey, but you've got a pretty interesting case and so now it's in appeals, and that's where it's at now. But what that does, though, is give us the ability to have a reasonable basis for moving forward with amending returns, with not reducing deductions for 280E, doing what's called protective claim for refund. It gives us a reasonable basis to move forward without taking 280E. And well, you have to take it into consideration, but you can essentially say no 280E. And it's allowed, and you're allowed to do that, because if it goes up to the Supreme Court and Supreme Court says no, overrules this, overrules the CSA and says, hey, the CSA doesn't apply to states with their own cannabis policies, then that means it was unconstitutional the whole time. And that means that money is ours. It's not the government's. And the reason why I say that it's likely going to be overruled or the court will rule in the favor of the plaintiffs is because there's like 7 of the Supreme Court justices now are all in the same camp as Clarence Thomas. It's an incredibly conservative Supreme Court, and if they rule with with their ideology in mind, small government, states' rights, then it should be a no-brainer, right? When it gets to the Supreme Court, they'll rule in the favor of the plaintiff, right? I mean, that's the idea of having a conservative Supreme Court. Let's see here. So other things. So like the biggest indicator to me is Dobbs versus Jackson when they overruled Roe versus Wade. Like if that's not signaling states' rights, I don't think there is anything. And then another case that's really interesting is when they overruled Chevron deference. That's definitely a blow to the federal government. What the Chevron deference did was it pretty much gutted the federal agency's ability to enforce their own regulations. So back to the IRS putting on that wet blanket over 471C and saying, hey, this is law now, this is regulation. They have no teeth at all to enforce that. They can't enforce that at all. That has to go to the courts. They cannot enforce that. So the Chevron deference was a big deal in terms of signaling more states' rights, limiting federal government, federal powers, more states' rights. There's other Supreme Court or constitutional arguments under the 16th, 8th, and 5th Amendment. I won't go into them today. You can definitely do a little bit more of your research. The prominent one is the Commerce Clause. That's the prominent argument, but there's other arguments saying why 280E is unconstitutional as well. So what is the typical percent of overhead do you move into inventory? What is a typical percentage of overhead do you move into inventory? That doesn't apply anymore. You can have whatever inventory you want as long as it matches your books and records. The method that we did was anything that was required for conducting sales through your dispensary or your farm or your business was put into inventory, and only things that were very discretionary we would leave out, like marketing, advertising, just some really overhead expenses, like maybe bookkeeper, and professional fees. Professional fees, advertising, marketing, we would leave below the line as expenses. Everything else, 100% of payroll, 100% of facility costs, licensing, software expenses, anything and everything that was required to conduct business in your dispensary, your business, we would put into inventory, and then we would leave a little bit at the end of the year, and we would write off all the rest. And that got that effective tax rate down to like 30%, And the federal, and for C corporations, it's 21%, right? So we did take a little bit of a hit, but it was a lot lower. It wasn't 50%, it wasn't 60% effective tax rate. It was like, 30% and under. And that's what we've been doing for like 5 years now. And so far, knock on wood, I'm not even gonna say it. I can't say it in case there's an IRS agent ready to pounce on me. But going forward, it doesn't, 280E doesn't apply anymore, and I'll tell you why. Now, amending returns, so for 471C, you have to you have to do what's called an inventory election request, a 3115. You have to request to change your inventory methodology. It has to be done at the time you filed return. So you can't go back and do it. You can only go forward and do it. So you can do it for 2024, but 2023 is over. 2022 is over. So now what you can do going forward is just say no to 280E. And I'll tell you a little bit why I say that. Okay, so this is the other big thing that happened. In fact, I'm going to go one more slide forward. This is so interesting. So the Department of Justice's Office of Legal Counsel went back and reevaluated the DEA's test for determining whether or not cannabis or a substance in general had a medical use. So as you know, cannabis is a Schedule I drug, highly dangerous, highly addictive, no medical use. So the DEA, or the Department of Justice itself, the DEA is an arm of the Department of Justice, I think. I'm pretty sure it is. And the Department of Justice went back and it looked at how the DEA was determining whether or not cannabis had a medical benefit. And they said in their memo that the DEA's test was impermissibly narrow, meaning they didn't agree how the DEA was classifying cannabis into a Schedule I or Schedule II drug. The DOJ itself, this is the important part, the DOJ itself said cannabis essentially should not be a Schedule I or Schedule II drug because they found their test to be impermissibly narrow. That's a huge thing, right? Because they're saying itself that they're kind of wondering, well, should it be a drug or in a Schedule I or Schedule II? Then that's when the HHS came out and said that we should reschedule it. They're recommending we reschedule, and the DOJ is recommending that we reschedule now to Schedule III and Schedule I. So what does it mean? Does that mean that cannabis was a Schedule I drug until 2023? Like it had medical benefits, it was highly dangerous, and it was highly addictive up until the HHS decided that it wasn't? Or was it never dangerous? See, that's the reason that it just doesn't make any sense that we would fuss around with this anymore. So now, look at this. The question is, does 280 even apply at all? If you look at the tax code and you get to the IRC code 280E text, no deduction or credit shall be allowed for any amount paid or incurred during the taxable year in carrying on any trade or business if such a trade or business or activities which comprise such trade or business consists of trafficking in a controlled substance. And then here's the kicker, and I should have just highlighted that part, but in the parentheses, it says within the meaning of Schedule I and II of the Controlled Substances Act. So if 280E applies to a substance that is within the meaning of a Schedule I or Schedule II drug. So if the HHS is saying, hey, we need to reschedule it to Schedule III, if the DOJ is saying we need to reschedule it from Schedule I to Schedule III, does it fit within the meaning of a Schedule I and Schedule II controlled substance? Because 280E doesn't apply to cannabis because it's a Schedule I or Schedule II drug. It applies to cannabis because it falls within the meaning of the Schedule I and Schedule II controlled. It applies to substances that are in fact highly addictive, dangerous, and has no medical value. So the question that I offer to you guys is based on this: does cannabis even, by definition, is cannabis even a Schedule I or Schedule II drug? Does 280E apply if if cannabis doesn't fit the meaning of the schedule of Schedule 2. I don't mean to be kind of, I'm getting overzealous a little bit here. So here we go. We got another question. Can you share more of your thoughts on using a protective amending filing? I think that a protective amending filing is very good. Like that, I would say that that's a little less aggressive than amending returns, because what a protective amended filing, we call it a protective claim for refund, does is that it just keeps the statute of limitations open. So if you haven't gotten one in for, okay, so and I'm gonna talk about the statute of limitations here pretty soon, but I really wanted to hit home that there is a really good argument that 280E doesn't apply to your businesses right now. And there is a really good argument that 280E didn't apply back then either. Okay, and not only is 280E a violation of the Constitution, the CSA is a violation of the Commerce Clause, but now we have this. This is the cherry on the amendment sundae, if you will. Cannabis does not fit within the schedule of the CSA, and that's the schedule right there. It shows drug or other substance, high potential for abuse, no currently accepted medical use for treatment in the United States, highly addictive, high potential for abuse. And here's the other reason, like THC is already being prescribed as a medication. There's pharmaceuticals that are synthetic THC. So what part of the cannabis plant doesn't have a medical use? Is it because it's in the flower form that it has no medical use? You know, what about tinctures? What about edibles? Like, I know smoking, it's debatable. Like, smoking is like you're trading one thing for another. But how is eating actual plant-derived THC worse than a pharmaceutical, prescribing it to you? That's another reason why I would say we have a reasonable argument. Like it's FDA approved. THC is FDA approved. It's a Schedule 3 drug already. So anyway, it's bonkers. All right. So let's get to the statute of limitations. This is so the IRS put out a news article, said, hey, 280 still applies, and and my argument is that yes, it does. It's fine if you want to believe that, but you might have to debate it in an audit. That's what they're saying is like, hey, we're going to audit you if you try to amend. We're going to audit you if you try to if you say no 280E and you move forward with that. We're going to amend because 280E applies. Or we're going to audit you. And that's true. They could, but what's the fallout from the audit? If you've got good books and records, if you've got substantiation to prove your expenses, if you're not afraid of an audit, then the worst case scenario is a long audit process, which is annoying. I get it, but it's not going to take your business down. It's far worse to not claim your deductions. Like, that's so expensive, and it's hard to get them back once you pay it. So why pay it? Okay, so protective claim for refund is what I was talking about. It's you can do an amendment and then call it a protective claim, meaning you're going to file an amended return, but you're going to do it with the contingency that the Supreme Court rules in favor of Verano Holdings. Okay, saying 280E was unconstitutional and it should never have applied to, or CSA. CSA should have never been applied federally or to states with their own cannabis policies. If the Supreme Court says that, then it triggers an amendment, your money, and you get your money back. Like that's the rule. Because right now there's what's called the statute of limitations. So you have to amend your prior tax returns within 3 years of the date that you filed, or the extension date if you filed after the extension date. So you only have 3 years. 2020, the statute of limitations is over. For most of you, you can't go back and amend those returns. They're gone. Now, there's some other ways we might be able to pick up those lost deductions, but as far as getting cash back, it's over. Now, if you haven't paid your 2020, the other thing though is it's 2 years after you've paid your taxes. So if you haven't paid your 2020 returns, if you haven't paid your 2019 returns or anything, then the statute of limitations is still open for you. Because the statute of limitations is the same statute of limitations as the IRS has to audit for you. So they can't audit 2020 right now. 2020 is closed for a timely filed and timely paid return. The statute of limitations for the IRS to audit you is closed, but it's also closed for you to amend for a refund. So right now you have, assuming 2021 is open. 2021, you can amend 2021, you can amend 2022, you can amend 2023. Those are all open. The statute of limitations are open. And then again, if you haven't paid your previous year tax returns, then those statute of limitations are open as well. So if you owe a bunch of money, you can amend your return and then get that liability reduced. So that's really cool. I think I spent a lot of time on this, Jesse. Maybe we just go ahead and open up for some questions. But my point though is that we just really need to, you kind of just need to act now if you want to get your money back. And again, it is a risk. We don't know what that risk is. I'm going to assume that the risk is high. You want to go forward with the idea that the risk is high, that you're going to get audited. So are you afraid of an audit? That's the question. If you're afraid of an audit, it might not be for you. Let's do a protective claim for refund. Do the protective claim for refund, because that will keep the statute of limitations open without being as aggressive as actually amending a return. But once there's conclusion that 280E shouldn't have applied, then the protective claim for refunds will work. But until there isn't that, then that protective claim for refund won't work. That's why I'm kind of like, hey, amend for a refund, because we don't know if the Supreme Court's going to get some strange hair up their rear and decide that the CSA did apply because they don't like cannabis or something like that. I don't know. I think it's highly unlikely that they're going to lose that court case. All right. Can you share the slides? I can. If you go to our website and then you click on, let's see here. I'm just going to go to our website here. Oops. If you go to calixcpa.com and you go to this little button here, Challenge 280E, okay, you'll see that we've done something similar already. This webinar has already been presented by my colleague Jamie, who's my business partner, and Nick Richards. And we did that for accountants because we were trying to teach accountants, hey, you need to be doing this. This is what you should be doing. And Nick Richards just second to none. He's like definitely been our mentor for all these years. But you can get the presentation documents right here. It's not quite as up to date as this one, but if you wait a little bit, I'll get them up to date. Or you can just email me and I'll email you the slides. All right, what else? Nice. Okay. Let's see here. Let's see, does anyone, okay. I don't know. I think that's about it. Can you talk about ways metric can be used to substantiate amendments to COGS? I think metric is a seed to sale. The seed to sale of the system is great for rebuilding books too. It definitely reports sales. It reports the payments to businesses. I think it's fine. You should be using QuickBooks or something, some double entry accounting system. You should have a cash log if you don't have cash, or if you don't have a bank account, you should be using a cash log. That should all be going into what's called the double entry accounting system. Your overhead expenses should also be listed. And then your accountant should be working with you to make sure that your inventory methodology matches your books and records. And that's going to give you the opportunity to maximize 471C. Otherwise, when we file a return, we put in a 3-page disclosure using a form what's called 8275R that tells the IRS to take a hike. Not really. We don't tell them to take a hike. We just say we have a reasonable argument. We will be at MJBiz Con. I don't know the booth right off the top of my head, but it's down the main aisle. We got a really sweet spot this year. So if you just walk down the main center aisle down to the food court, kind of towards the back by the business services, we're on the main aisle. We got a corner booth. You guys can come and visit us for sure. If that is it, I say, Jesse, you have any questions? What do you think the Oregon cannabis industry wants to know?
Hold on. Oh, I am unmuted. Okay. I was going to say, could you, I mean, you talked about a lot of stuff, lots of really great information, and I would say two things. One is, could you give a concrete-ish example of some of the, people adopted some of the things you talked about today, like either customers or stories of how this has helped businesses, and how people have thought through the process here a little bit, then I think that's the best thing, because the Oregon market is a little bit more stressed than others, and I think everybody's looking for ways to find savings, and maybe even some would say financial lifeline.
Yeah, I mean, not having to deal. I think you know how the ERC was, where people were getting the ERC during after COVID, and everybody and their grandmother was applying for EAC and getting all of a sudden getting checks back and stuff. I would say it's not as easy as that, but it could be a lifeline. I just was talking to a gentleman who had $1.5 million of disallowed deductions. That equates to about $300,000 of potential refund. So we're going to go back and amend 2021. We're going to reclaim the 1.5, and then ideally he gets a refund. So just to be very clear and transparent, we started amending returns in September, and it usually takes at least 3 months for the IRS to get off their rear and issue that check. After 3 months, if it takes that long, what we usually do is we call up and say, hey, you can't sit on this forever. You need to do something. You could either audit them or you need to give them the money. So we're kind of reaching that point right now. We went forward with almost all of our cannabis clients in 2023 without reducing deductions. So that was a lifeline, right? Lower taxes for them. Granted, with the use of 471C, it's not as good, but for people who haven't been using 471C, it's a boom. It's like the first year that you don't pay all those extra taxes on phantom income. It's really nice. We're waiting for the checks right now. So I've heard from my colleague Nick Richards that the other CPAs that work with him and have drank the same Kool-Aid as we did are getting refunds. They were ahead of us. We kind of waited until the statute of limits of 2020 because we didn't want to give the IRS more time to audit, because that's the nice thing about the statute of limitations is it counts just the same as for the IRS. So what I'm saying is the IRS has the same amount of time to audit your tax return as we have to amend for a refund. So if we amend for a refund late in the statute of limitations, then the IRS only has a small period of time to audit. So it's kind of a strategy. Now, 2021, the statute of limitations don't close until March and April without an extension, September, October with an extension, or whenever you filed the tax return. So the statute of limitations are over in 2024 for 2020 or 2025 for 2021 when you filed the return. And if you filed it late, it would be September or October if you also filed an extension for that return. Or going even 2020 is still open if you haven't paid yet. So that could be really nice, right? You amend 2020, they don't have to give you a refund. They're probably going to be okay because we're not going to add more debt to these people. And they might, all of a sudden, you might get a bill that says, you owe 300,000, woo, now you owe 0, you know? So, so we have to wait to see. The environment is much like 471C, where there was a lot of like, oh, the IRS is going to get you. We never saw that with 471C. We never saw it. I feel the same. Like, I feel like the accountants and the tax attorneys are doing the IRS's job for them very well by scaring the shit out of their clients. I think it's like a 50-50, maybe a little bit less. Like the accounts, if you poll the accounts are like, yeah, I think we're okay with amending or going forward without 280E. We're not okay with amending. Some of them are like, okay, we'll go forward without 280E. We will amend. Some of them are like, we'll do protective claim for refunds. We'll put that in there. That's totally low risk. Protective claim for refund is like the lowest risk thing you can do. So yeah, that's what I would say. Okay, right on, you guys. It's 11 o'clock, short and sweet. I hope that this hasn't been enlightening and you're not as scared as you might have been.